been asked today to talk to you all about my journey to impact investing and how it came to be. I mean, to be honest with you, it was really one of the easiest decisions I've ever had to make. I mean, if you all know that the hashtag Become the Change, Become the Change is now instantly recognizable. And this was one of the actual phrases coined by Mahatma Gandhi in 1913. I mean, he wrote a piece, and from that piece, people such as Barack Obama, the United Nations, etc., have adopted this hashtag as part of their global sustainable development goals. And this really is integral in the decision that now how my business partner and I view our roles in helping entrepreneurs in choosing our investment themes that our new fund, which is called Two Magnolias, is based on. So as the sun set on my career in global markets, I mean, I knew there was an opportunity that, an ocean that we had to drop into that was very different from the muscle memory of 5:30 alarm calls and 12-hour days. I mean, you know, when my body was allowed to literally stop and breathe, last year, what we discovered and what I discovered was that there was so much happening in the world that we just didn't have access to, even though I was involved with, you know, a large global capital markets bank and a very influential global operation. Actually, when we stopped to think, there were many things that were happening in the world that we just wanted to be part of. So we decided very early on that we had to look at what part of the food chain we wanted to sit on. I mean, not being entrepreneurial in skill set ourselves, you know, we're not deep tech people, and we certainly can't compete with, you know, the millennial wizards that all of you are. So we decided that the area that we could, and the part of the food chain that we could easily sit on, was to really mentor, guide, and invest with those of you who needed support and who needed pulling through. And so in that vein, that is when Two Magnolias was born. So Two Magnolias is basically a fund which has two female founders. We have about 50 years of global markets and asset management experience. We have 94 years on this planet. We have 26 years as mothers. And we have experience with generations from Generation X to Generation Alpha. We are members of the UK British Angel Association. So far, since January 2020, we've done 40 pitches. 40 pitches from companies that had 16 female founders, 5 of which were BAML founders. We've made 2 investments. We have 1 investment which is currently in legal doc stage, and 2 which are in the data room. So our targets for 2020 are very clear: 5 to 7 investments, $500,000 of capital deployed, portfolio duration of between 3 to 5 years, with an end of year multiple of about 4x. So the 2 founding principles on which the fund was built are sustainability and human longevity. Sustainability is the planet. Human longevity in all its various forms of health, nutrition, exercise, medical intervention, and medical technology focuses on humanity. So these are the 2 pillars around which our business has been built. Just finished a course at Yale School of Public Health on climate change and communication. It was extremely illuminating to me, because as we spent the first 6 weeks of this course going through the science of climate change, I must tell you, we all know about it, but we don't believe it as a society. Or if we believe it, we don't act on it. You will get a feel of the types of facts that are out there that really society as a whole doesn't grasp. 1.7 planet Earths are needed right now to sustain resource extraction and waste at our current level. 29 years until the Earth runs out of food if global systems are not transformed. 19 years until the world runs out of fresh water, unless water use is dramatically reduced. 17 years till the end of rainforests if current deforestation continues at this rate. There is no debate that we need to focus our energies on finding solutions to our current consumption rates. We are currently 7.8 billion people, 4.1 billion of which are consumers. But the solutions to this need to be very targeted. And sustainability as a term is not a catch-all phrase. And what we did was we actually looked at the UN Charter on Sustainability. And the UN Charter actually looks at 17 specific global goals. And these sustainability goals are the blueprint to achieve a better and more sustainable future for all of us. They were formed in sort of 2016, and they are the 17 goals that by 2030, the United Nations expects the world's global community to try and focus on to achieve sufficient sustainability that we're able to allow the next generation to progress. The second pillar is human longevity. And this, the impact of an aging population is very complex, very multifaceted. It's a very difficult topic to unpick. And what we're not simply trying to do is to unravel healthcare issues associated with aging or on an individual basis. What we're looking to do is really focus on the fact that governments are going to be unable to deliver on their health commitments to the public, to their people, over the next 20 to 30 years. The problem is, whether they are resource-rich countries or poor countries, people are living longer. And it's an undeniable truth that aging is inevitable. The odds of living to 100, from birth to 100, were at one stage in the beginning of humanity, 1 in 20 million. Today, 1 in 50 females in low mortality countries, such as Japan and Sweden, have the opportunity to live to 100. That is a massive increase in the number of elderly people that we're going to see on the planet. So in that way, if you look at the costs of treating cancer, in 2015, the cost of treating cancer was about $300 billion. That was for 13 million new cases. In 2030, there's going to be triple that number of cancer cases. Just think then the $1 trillion that is needed just for that year to help cancer victims. It is going to be totally unaffordable. So what is impact investing? In fact, if those are our two pillars. So impact investing is a movement, a new movement that's afoot. It's not really that new, actually. It was first coined in 2008, and it represents a significant opportunity for businesses and markets to drive social value. So they drive social value by allocating assets towards products, services, and companies that generate positive social impact in specific areas. And those areas are very targeted. And for many years, people have been confused between philanthropy and investing. And they've been thought of as separate disciplines. One championing social change, the other one was very much for financial gain. Now, philanthropy meets investing, and that is what we call impact investing. And the idea really now for investors such as us is to decide what part of the impact investing spectrum do we lie. We're certainly not in the traditional investing spectrum, and we are not in total philanthropy. We sit in the thematic investment for-profit part of the spectrum. And I will send you the spectrum so you can all see it. And if you look at it, a recent survey of asset managers says that 86% of their investors, when they have ventured into delivering their dollars to them, are demanding impact investing as part of those investment dollars. So demographic shifts are driving some of this demand. And if you look at it, Cambridge did a study last year, and the study found that the median investor would prefer a sustainable fund, even if they had to sacrifice between 2 to 3% a year in performance. So in total, 75% of respondents said they preferred sustainable investing and sustainable funds above anything else. More interesting than that is that those below 35 were more likely to choose funds with higher sustainability scores. So the demographics now of what is happening globally are absolutely vital to this new form of investing, because this is where capital is going to move. So if you look at the value of the current impact investing market, it suggests that it's worth about $9 trillion in the US alone. And if you look at some of the numbers that are needed to fulfill. So there is the funding gap. The United Nations says the Sustainable Development Goals that I talked about earlier, those 17 goals, the annual funding gap globally for that is about $2.5 to $3 trillion. So the world needs about $2.5 trillion a year to ensure that we can progress these sustainable development goals. Just 1% shift in global capital markets. So if you see the total global capital market investments worldwide is $300 trillion, 1% shift completely closes that funding gap. So you can see that the money is there. It's just the investable space is currently not focused on this. And if you look at the generational move, as I mentioned earlier, in North America alone, $30 trillion in wealth is going to be transferred over the next 3 decades from baby boomers. So the baby boomers are the ones who are sort of, 55 plus, 55 to 75. $30 trillion is coming to Gen X and millennials. Okay. And remember, younger investors favor social and environmentally motivated strategies. And they're willing to invest large amounts. Now, the one generation that you should all now start to familiarize yourself with, and I'm sure you have, is called Gen Alpha. I don't know if you've been taught about Gen Alpha, but Gen Alpha are children who are born in 2010, post 2010. They are the ones to watch. They have criteria which none of us will necessarily understand, but their passion for doing good and for service is definitely outlined. And I'll again send you the data which shows what their criteria are. Their number one criteria for them in their lives is going to be family, followed by friends, followed by happiness, followed by health, followed by education. Money comes about 8th down in the list. They're not interested. I mean, the one thing that you need to know about Gen Alphas is they are the first generation that is going to spend their entire life fully immersed in technology. Their annual spending power will be about $200 billion, and they will have around $10 trillion of invested wealth as they come into their, when they're 18 and 19, when they become adults. And they are going to demand that things are different. So their delivery expectations for Amazon are going to be sort of 2.25 days. Currently, our delivery expectations are around 3. They're going to be more interested in following influencers than they are going to be in following big corporates. And their impact is going to come purely from media, from online, and from ads. They're not interested necessarily in impact from anything else. So, one of the things that companies will have to do as Gen Alpha comes into the consumer part of the market is that they will either survive or they will fail. They will be the generation that determines whether old style companies survive or don't. And that is the reason, and that is, as I may go full circle, that is one of the reasons why we have chosen to build our investment fund the way we have done, because not only is it just that there are 2 trains that are on the station, the train of sustainability and the train of human longevity, but there is a very large generational shift that is happening that is going to determine that consumer dollars will move to companies that are focused on solving these problems, because they are real problems that the world has to deal with. And that is the reason that we set up Two Magnolias. That is the reason why we're in impact investing. And that is the reason why we believe that actually, as capital markets change, we need to change with them.
So is impact investment the same as social enterprises?
Yeah, I mean, I think there is, there are essentially, different parts of the investment spectrum and the impact investment spectrum. And, as I said to you earlier, you need to decide what type of investor are you. We are for-profit investment an investment fund. So we are focused on returns, and we are very focused on a specific part of return, companies with certain duration and exit, etc. So we are traditional investors, but focusing on these two pillars. Social enterprise tends to be linked to not-for-profit or government-linked enterprise. So, I mean, I don't want to generalize. You just need to decide what your return spectrum is. And some social enterprise is also based on specific solutions. So, for example, social housing projects. There are investors that specifically have set up funds to deliver, capital into social housing projects, which are then returned to low-income demographics who rent these social housing projects, and that's how their funds create a return. The returns are lower, but they are very socially driven. And again, we're not quite at that part of the spectrum yet, but you tend to find a lot of government influence in social enterprise schemes.
So the next question is it easier to leverage companies to drive sustainability rather than government?
100%. We fully believe in the private sector solving these problems. There is no way, just as I was saying to you earlier, there is no way that governments are going to be able to fund these projects. If you think about the SDGs, $2.5 trillion, $3 trillion funding gap, they can't do it. If you think about the global health issues that governments are facing, they can't do it. Now, the interesting thing is the global health funding gaps are coming from humans living longer, because there are solutions being provided to, cancer sufferers, obesity, etc. But essentially, there are going to be so many more. There are going to be, I think, in the next 5 to 6 years, more elderly over 65s on this planet than under 5s. So, the majority of the world will be people who are not necessarily contributing economic dollars to GDP. They are retired. So solutions have to come from the individuals. We have to live healthier. We have to be healthier. Some of the things that I would encourage you to read. So for example, Dr. David Sinclair, I'm a real disciple of his. He's a professor of genetics at Harvard. He wrote a book called Lifespan, which you probably heard of. He is specifically looking at the idea of aging. And he thinks that actually it is going to become more normal for people to live to between 90 and 100. And what is important to note is that actually nutrition counts for a lot. And Dr. Mark Hyman, again, a very interesting doctor who looks at functional medicine. It says that functional medicine, which is whole body medicine, not specific, not these specialisms where, you look at the brain, you look at the heart, you look at whatever, you look at the nervous system. Functional medicine is going to be the medicine of the future. So people will be looking at prevention rather than treating disease. Because governments won't be able to fund it. So,
are the returns expected from impact investments lower than traditional investment firms?
So it's not about whether they are going to be lower. We don't expect them to be lower. The interesting thing is that people who are happy to invest in impact funds are willing to accept lower returns. So, I don't know if I mean, when I was in global markets, one of the things that happened with, say, the hedge fund community or with the fund management community is that there was a race to zero on fees and returns that investors were willing to pay for traditional hedge fund outcomes. So they were saying, the hedge fund returns, they used to be, if you wanted to put your dollars, say, with a Brevin Howard or whatever, it was 2 and 20 or 3 and 40 or whatever it is. But as I left the business, those were reducing to zero because I think investors had lost patience with the lack of returns. That is not happening in impact investing. People want to put their money there. They're willing to pay fees for people to invest on their behalf. And they're willing to accept lower returns because they know it's a force for good.
There are already a lot of VCs and PEs are talking about impact investing as in greenwashing. So how do you tackle that?
Yeah, I 100%. I looked at that question. That was the one I wanted to answer. I 100% agree with that. And that is the reason why we are so clear about what we're doing. And we won't we won't invest in companies that are outside these pillars. And we have had the opportunity. We've definitely had the opportunity. And in fact, we've came very, very close to investing. I mean, we looked at a company run by two fantastic female founders, and it was really because they were female and we wanted to give them a shot, and they were brilliant, and they really had sorted, it was a blockchain technology solution attached to film financing. And we looked at it and we looked at it, and then we looked at each other and we said, we can't do it because it did not meet the criteria that we have. Even though we could have said, we could have put the diversity angle on it. So I 100% agree with that comment. I think there are lots of VCs and private equity firms that now, if you look at their decks and you look at what they do, you know, you'll see fintech private equity firm, you know, blah, blah, blah. We're fintech experts. We got, you know, 100 years in fintech, et cetera, et cetera. And we like sustainability. I mean, it's just a nonsense. There are so many companies like that out there. But you know what? Actually, doesn't matter. Doesn't matter if they are willing to do that. Doesn't matter because ultimately they have investment dollars to spend. Doesn't matter that once in a while that these guys are going to invest their money in sustainable companies. You know, let them greenwash. I have more of a problem with, you know, Shell trying to greenwash themselves. I have more of a problem with that, you know. So you kind of got to decide what battles you want to fight.
One question that I have is that, you know, as the companies raise the subsequent rounds of funding, a lot of different investors might enter, and they might have different expectations as regards the way of working as well as the returns than you have, or that were set forth at the time of launching a venture. So how do you come on a common ground with all these investors and co-founders and founders?
I know. Yeah.
It is really difficult, right?
It's a very difficult thing. And to be fair, Nikhil, I mean, as you know, we're very early in this, but I've often thought of this. I've often thought what actually happens at the time when we are able to participate in a Series A or a Series B. You know, can't see further than that. In reality, I can't see further than that yet. But what actually happens? And I think, you know, you have to decide. One of the things that I've learned over the last 6 months when you're looking at these deals is how big do you want to be, you know, in these deals? You know, so if someone's trying to raise £500,000 or £1 million, how strongly do you believe in the deal and how big do you want to be in terms of your kind of, you know, investment dollars? And I think when you're talking about influence and you're talking about obtaining a consensus around what you believe in, I think that's where that debate happens. And I can envisage it's going to be very difficult. It's going to be very difficult because there will be people who greenwash themselves, come into a deal and then behave badly once they're inside. And I think it will really depend on how big you can be at the point where you have highest conviction. So I think it's that sort of triangulation. So if you're, you know, if you have high conviction and you can be big and you can lead, then lead a deal, then I think there's no debate. I think then you can hopefully construct a solution around that. But I think it's an excellent question. And it's an excellent question because I go back to my point when I first talked about sustainability and what's happening in the world and all the years. I mean, those aren't just years, by the way. If you go onto Google, you guys can download the Earth's global clock. There's a global data clock. It's got all it's brilliant. It's got every date, time, year countdown you could possibly want when it comes to poverty, people, humanity, the earth, etc. I don't understand why people would have different outcome expectations, given what we all know. Do you understand?
Yes, thank you.
The question I was trying to ask is that generally what happens is that the general venture capital and private equity investing, it's always in series, and for getting subsequent investments, you need to uh, fulfill some targets, and financial targets are very easy to put in place. Like you have to double the money and then we'll invest more, and then you triple the money, we invest more, and further like that. The sustainability targets are pretty hard to manage that way, because it might be that the entire sustainable impact would come out at the end, supposedly after 2 or 3 years. But financial targets are set for 6 months, 9 months period only.
Yeah. Oh, I see your question.
So
Okay.
yeah,
Yeah, I see your question. Okay. So what you're saying is companies that have sustainability targets, as you know, if we impose sustainability targets on companies, then it's difficult to necessarily for them to raise money, is what you're saying. Yeah, and compared to financial targets. So what we're not doing, so what we Two Magnolias is not doing is looking at companies that have set. So for example, banks. Okay, Bank of America has a very big sustainability target. They have ESG targets. They have governance targets. They have green bond targets. They along with all banks are trying to greenwash themselves completely. Goldman, for example, has now stopped investing in any companies that are extracting, from the ground, etc. Those are companies that have sustainability targets, but they are not businesses that have their entire ethos based in sustainability. Do you see what I mean? So there's a difference. So we're not investing in companies. We won't invest in banks just because they have strong sustainability targets. We only want to focus on companies who are developing products or tech that solve sustainability issues. Do you understand the difference?
yeah,
Sure.
yeah. I really appreciate that part. Supposingly, just to follow up on that, you invest in companies which are looking for those sustainable goals and everything else. At the end of 2 years, you find that the company has fulfilled the financial goals which you had in mind, 4 times, 5 times, 8 times return, but the
Mhm.
sustainable goals have not been met.
Oh, well, then we
So
have a problem. Well, then we have a problem. Yeah. I mean, if they veer off track,
yeah,
yeah, then there's a problem.
yeah,
100%.
because then you cannot consider it as a success, because you want to be an impact investor in that case.
100%. If we invest in a company and they change their you know what they're doing and who they are and what they're based on, yeah, 100%, then we have a problem. Definitely.
Okay, thanks,
I
thanks
don't
for
know
that.
what I don't know what I don't know what the solution is yet, Sharat. I hope that doesn't happen. I hope somebody who's planting 1 trillion trees doesn't start digging up a platinum mine in, Kazakhstan or somewhere.
Due diligence is the answer, perhaps.
I know, that's right, 100%. We need someone. We need someone good to do that.
What are your plans to grow Two Magnolias? Is it currently just you and your co-founder, Marie?
Yeah, it is. So we are. It's currently just us. I say. I think we're. I think we've done all right so far. I think the thing with us is, because we are an angel fund, we need to establish our portfolio. Once we have a portfolio, we can value it and we can apply a multiple to it. Once we do that, we can decide if we want to move to VC. If we move to VC, then we will apply a fee approach to the dollars that we take in. And then we will expand our kind of umbrella. We don't really want to have a high cost business, but we want to have people who are very relevant to us. So we think it'll be important to have a good quality advisory board. And we think it'll be important for us to have a couple of excellent analysts in these particular fields. We already have a great lawyer working with us, and we'll probably need a COO. So we'll start as a sort of small venture, but I think what's more important is that we do not expand too quickly. Now, I will tell you what we believe the iteration of Two Magnolias looks like. So Two Magnolias as the fund is the fund called Two Magnolias Limited. We also have a company called Two Magnolias Creative. Two Magnolias Creative owns the Two Magnolia brand, and we license it to our fund. So our portfolio of 6 or 7 investments, if BlackRock say, you know what, we like your 12 investments, we like the multiple applied to them, it's really cheap for us, we didn't get into these small companies early on, we'd like to buy your portfolio, we can sell that portfolio without selling our brand, Two Magnolias, and then we can go again. So this structure allows us to repeat the same kind of investment approach. And it's slightly different from the way other angels invest. They normally invest as a syndicate, but once you're in a syndicate, you're very much tied to what all the other angels want. We didn't want to do that. We wanted our ability to be very flexible. And the other thing that we will do, and we are setting up associated with Two Magnolias, is Two Magnolias Foundation. So when we move to VC and we start taking a fee, some percentage of that fee will move into Two Magnolias Foundation. In fact, the foundation will be run as a not-for-profit. And that will have a separate organization. We won't be able to run it for governance reasons. We would need to have a separate, board to run that. But as those fees come in, that will be a cash generating foundation that can then invest not-for-profit. And actually, in answer to the question on social enterprise, that's where those dollars will go.